Time now for the business news and the question whether we're paying too much for our food and whether that is the fault of the supermarkets. A question they will face as they face a committee of MPs today to answer questions about continuing rises in grocery prices. Sean can tell us more. Morning, Sean.
Morning, Nick. Yeah, it'd be a fascinating back and forth between those MPs and the senior figures from Tesco, Asda, Sainsbury's, Morrison's, who are up to talk about why food prices are still rising rapidly when some wholesale costs, the prices paid by suppliers, are falling. Now, latest data from the body that represents the supermarket sector, the British Retail Consortium, shows today that food price rises did continue to slow in June. That's the price rises continuing to slow, still rising though at 14.6%. In the latest official data as well, we'd seen sausages in particular seeing prices grow 20% in the year to May. And I've got somebody who knows all about that. Jamie Keeble, co-founder and sales manager of Heck, which supplies its sausages, burgers and other products to supermarket shelves. Jamie, morning to you.
Good morning.
Thanks for being with us. Have your products stopped rising in price on the shelves, or is there more to come?
Well, we don't know if there's more to come. I mean, we're just listening to your presenter a moment ago about the situation in Russia, and that looks like it's reaching a sort of critical point. But no, we've not seen it at all, to be honest with you. The raw material price of pork and chicken is still very, very high, and we haven't got a crystal ball. We don't know when that's going to start to go the other way.
You haven't got a crystal ball, but I'm assuming you are having conversations with supermarkets about what that price is going to be in the months to come. How much higher do you expect the next move in price rise to be for your products?
Well, the retailers like to keep their cards close to the chest, so we don't really know exactly what their thoughts are. We can only speak to our suppliers where we think it might come, but we see the price of pork, for example, being extremely high for the next 18 months. And beyond that, we're not too sure.
So does that mean in 18 months' time, the price of sausages will be a lot higher than it is right now?
I think they'll stay where they are. I don't think they'll go much higher. Well, I hope not anyway. But they'll still be very high on shelf, and I think they'll start to really fall in about 18 months' time, we hope.
So we might see prices fall. So that's what I wonder. This is going to be a key part of the conversation today, isn't it? Why aren't we seeing some of those food prices? Milk and eggs, for example, still relatively expensive compared to pre-COVID. Why aren't we seeing those get back to where they were?
I think it's got to do with the sort of net effect of what's happened, really, I suppose. I mean, everyone's costs have dramatically risen over the last few years. As a brand, we've had to really sort of put a halt on our sort of growth operations for the last 18 months and really focus on efficiencies and production.
Do you think supermarkets should be doing more generally, though?
I think they can always do more. Of course they can. It'll be interesting to see what happens from today, if they will look to try and lower the prices on shelf, but the only way they're going to do that is come back to their suppliers and start having them on cost as well. So we're certainly not in a position to start giving cost decreases on our products.
A couple of things there. What more do you think they could be doing right now for customers, supermarkets?
Well, I guess, if you look at especially the big four, they're definitely sort of doing spending a lot on their sort of loyalty schemes and loyalty cards in the retailers to look to sort of help consumers that way. I think, at the end of the day, they're going to have to take a cut in their margins if they really want to lower the prices on shelf. That's the only way to do it. But of course, they've got shareholders they want to protect, and it's their job to do so.
And that point you make about, maybe the fallout of today is they do look to keep prices a bit lower, but they come and have a conversation with the likes of yourself, the supplier.
Yes.
How much wiggle room is there?
Not a lot. From our point of view, definitely not. I mean, we're as efficient as they get. I mean, we're a strong, independent family business, and going to the retailer for a cost increase is the last resort, and we're certainly not in a position to start talking about decreasing at the moment.
And just on a bit of a separate issue, Jamie, in recent times you've cut back your vegan range, something that you've gone quite strongly into at some point. What changed?
I guess, well, unfortunately for the sort of vegan market, there was, massive growth about 18 months ago, and unfortunately this year it's really sort of slumbered a little bit. And I think it's because the cost of vegan products are quite expensive, and I think the consumer at the end of the day isn't willing to sort of start experimenting and spending their hard-earned money.
Are they going back to meat, or are they going to other non-meat products?
Well, it's funny, really. I think they're going to sort of other non-meat products as well. I think meat will be here to stay for a little bit longer, and I think vegan will have its day in a few years' time. But unfortunately, there's been so much sort of product development in those areas, and the market's not hasn't really grown with it as well. So it's been a bit too much too soon, I would say. And
Jamie,
with everything that's going on, it's just been a bit hard to handle.
interesting stuff. Thanks for being with us this morning. Jamie Keeble there, who's the co-founder and sales manager of Heck. Got Will Walker-Arnott with me, senior investment manager at Charles Stanley. Will, morning. Cineworld, where they are struggling, we know that. Now says it plans to file for administration, but its screens remaining open. So what's the problem with the business if customers might not notice anything?
Yeah, so this is the world's second largest cinema chain, and they will shortly appoint administrators. The company is going to delist. It was on the public market for 16 years, and so existing shareholders are going to be wiped out through a debt-to-equity swap, and the assets are going to be transferred to a new company, and I think that operations are likely to slim down. So what are the reasons behind this? Well, I mean, Cineworld took on a lot of debt pre-COVID and went on a big expansion in the US. It's also suffered clearly from COVID and the lack of footfall. And finally, all the money going into streaming has been a big competitor for them.
The FTSE 250, which is those next 250 biggest companies after those major ones on the FTSE 100. Often the FTSE 250 said to represent the UK market a bit more, includes the likes of Marks and Spencer and Royal Mail. That's continued to have a bit of a bad run, the worst run that we've seen since maybe early pandemic days. What's occurring there?
Yeah, I mean, to put it into context, the FTSE 250 is down nearly 5% over the year to date, whilst the FTSE 100 is up about 2.3%. And if you look over the US, the S&P 500 is up 14%. I think, Sean, fundamentally, this reflects a lack of confidence in the UK economy. I'm not really sure where to start with a litany of reasons lying behind this, but one personal bugbear of mine is the lack of support from our pension fund industry, where they continue to have very low allocation to equities. Now, there are rumours that the Chancellor may address this at an upcoming Mansion House speech, and I sincerely hope he does. We need more capital to be driven to the equity markets, in particular our exciting life science and technology sectors.
And another way to have a look at what investors around the world make of the UK economy right now is the cost of borrowing for the government. What can you tell us about the latest moves? Because we know that they're so closely linked to the fixed mortgage market at the moment.
Yeah, well, we still have this, what we call is an inverted yield curve. So in the short term, borrowing costs are pretty high, and over 2 years, it's going to cost the government about 5% to borrow money. But it does then drop quite sharply. The reason for this, unfortunately, is that the market thinks that because of this excessive monetary tightening, that the UK economy is going to be pushed into a recession. So in the short term, borrowing costs are high, but it looks like they're going to come down on a sort of 2 to 5 year basis.
Will, thanks very much. Will Walker-Arnott, Senior Investment Manager at Charles Stanley. Hearing Will there talk about interest rate costs is Jane King, Independent Mortgage Advisor with Ashridge Private Finance. Jane, morning to you.
Good morning, Sean.
Quite a lot going on in the mortgage market at the minute. When Will talks about, that the cost of borrowing for the UK government being lower over a 5-year period than it is over a 2-year period, are you seeing those kind of changes in the mortgage market as well?
Well, it's very difficult because it depends on what report you read. I mean, your correspondent there has just said that they're looking at 2 to 5 years. But if you listen to what the government say about, the help that is now available to borrowers, we're looking at very short-term help. So that would indicate, from the government's point of view, that this is all going to be over, by the end of the year, inflation's going to be down to 2% and everything's going to be okay. So we are getting very mixed messages.
Well, yeah, I'm not sure about inflation down to 2%, but I know what you mean. It's been we've been told that inflation, how much prices are rising, will be coming down a fair bit. In the mortgage market, Jane, just in the last 24 hours, again, we've seen the cost of fixed rate mortgages over that 2-year period increase to a new 7-month high. Has it calmed down this week at all compared to last week?
Well, no, it hasn't, because we had the interest rate rise from the Bank of England, and just before the rate rise, a whole lot of lenders upped their rates, repriced them. We all thought as advisors that this had factored in the interest rate rise, but no, yesterday we had 5 lenders withdraw and reprice their mortgages. We wait till this morning to find out what the new rates are. We expect them to be high, but we're not sure by how much. But interestingly, it looks like rates for existing in borrowers haven't been mentioned. So whether they stay the same or not, I don't know, and I will be checking later. But yes, rate rises do continue with high street and off high street lenders.
And the Chancellor Jeremy Hunt was